Welcome to Straight Talk Tuesday. Today is July 14th, 2020, and we're kicking off our financial wellness series. Today we'll be covering budgeting basics. I'm Brent Bowers, a retirement plan advisor at Retirement Plans Inc. And this presentation has been put together in conjunction with Rich Myers, a retirement plan advisor at Retirement Plans Inc. Let's take a look at today's agenda. The key concepts we'll cover are recognizing income and expenses, creating a budget and uncovering insights, and lastly, financial security, savings, and emergency funds. Today's presentation is for informational purposes only and should not be construed as legal or tax advice. Please consult with your plan advisor and administrator to find out if this may be appropriate for your circumstances. Let's get started. Let's look at recognizing income and expenses. There are two definitions of income we'll need to understand for budgeting purposes. Gross income, which you can think of as like your salary. So for example, if you have a $40,000 salary, then your gross income would be $40,000. This is before any deductions for taxes, health insurance, 401k contributions, or the like. Second definition would be net income, and this is your take-home pay. This is what you would likely see direct deposited into your bank account or a check that you would receive on your pay cycle. Information for both gross income and net income can be found on your pay stub. What we want to also consider is other income sources, such as a side business or interest from savings. Now that we have a good understanding of the income definitions, let's move on to expenses. So there are two categories of expenses that we'll need to know for creating a budget. First, let's look at fixed expenses. These are payments that are not easy to change, things such as mortgage or rent. That would require you to sell your house and buy another one, or to move apartments that you may be renting. Things such as car payments, student loans, etc. Secondly, would be variable expenses. These are payments that we can control pretty easily. Things such as groceries or subscriptions to magazines, a membership at the gym, the number of times we eat out during the month. Those are all expenses within our control of how much we spend on each. So to find these expenses, both fixed and variable, we'll want to take a look at bank statements from our past couple of months to identify where our money is going. Now that we're able to recognize our net income and be able to recognize our expenses in fixed or variable, let's look at creating our budget. But first, here's a budgeting tip. If you have an expense that varies or doesn't occur monthly, use the average to account for it on a monthly basis. So this may be an expense such as car insurance that you're paying every 6 months. Let's start by looking at our actual budget. So a budget records your income less all of your expenses to tell us if we have a surplus, where income is higher than expenses, or a deficit, where expenses are higher than income. We'll then list our average monthly net income or take-home pay, and then we'll list the average of all of our expenses we have identified over the last 2 months, ultimately subtracting our expenses from our net income. This will tell us if we're currently at a surplus or deficit. And now that we have visibility to where our money is going, we want to mark each expense if it's essential, things such as rent or food, or discretionary, things such as a gym membership or a Netflix subscription. This will be used later on to identify opportunities for us to improve our budget. So now that we've done that exercise, let's review our budget and ask ourselves key questions to try and uncover some insights. As mentioned before, do we have a surplus or a deficit? Were there areas that we were surprised by the amount we were spending? Or are there discretionary expenses that we're currently incurring that we're not utilizing? Things such as an old gym membership that we've maybe never been to in the last year. Those are areas that we may be able to change to improve our financial situation. So along with these questions and other insights that you may uncover will help us to develop an adjusted or a planned budget. And this will allow us to either increase our surplus or to hopefully move from a deficit to a surplus. So now that we've done this and we've got our key questions and insights gained, we want to look at revising our budget. So how do we do this? As we mentioned before, If there's areas that you are currently spending more than maybe you're expected, such as maybe we are spending $200 a month on eating out, maybe we're able to reduce that to less frequency throughout the month and maybe only spend $100 a month. This will improve our financial situation. Now let's look at an example. In this hypothetical situation, you'll see at the top our actual budget as we went through this exercise we just defined. So you'll see that our income or our budget is $3,750 for the month. When we look at our actual expenses for the month, you'll see them at $3,860, resulting in a deficit of $110 per month. Out to the right here, we can look at the various summary categories. Looking at mortgage and rent is $1,200, utilities at $455 a month, and so on. Now, hypothetically, after we've got our insights from doing that actual budget exercise, we look at our adjusted budget. You'll see that our income has not changed. It's still $3,750. Our actual expenses, though, have decreased to $3,570, resulting in a surplus of $180 per month. If we look out to the right again, we'll see that the only summary category that has changed is entertainment. So in this hypothetical situation, we were likely able to uncover savings on the entertainment side. Maybe that was reducing the frequency that we eat out or getting rid of the gym membership that we're no longer using. So once we've been able to go through this, really our adjusted budget is what we're going to aim to hold ourselves accountable to in order to create a better financial situation. So once we do have a surplus, what is it that we do with that surplus to create financial security? So let's look at savings and emergency fund. A quick financial fact, 14% of US households would be unable to pay all bills if they incurred a $400 unexpected expense. While 14% of US households may not seem like a very high number, the reality of the situation is we likely all will experience an unexpected expense of at least $400 at some point in our lifetime. So now moving into creating financial security. What do we do once we've achieved a surplus? I would say everybody should consult their financial advisor because everybody's situation is slightly different. And the sequence in which you try to tackle some of these steps may vary depending on your unique situation. The goal is to start with having $1,000 in our savings account for unexpected expenses. This would be $1,000 that we keep in that savings account and do not use unless absolutely needed from an unexpected expense. So the next and most likely step would be to pay off high interest debt. Things such as credit cards that probably carry anywhere from 12 to 20% interest rate would be a big step in reducing our interest payment that we're incurring. This would create a better financial situation and hopefully, once paid off, increase our surplus where we can put money towards other things to create that financial security we're talking about. The next step then, after paying off high debt interest credit cards or other high interest debt, would be create an emergency fund. And this is important, especially during this time where we see unemployment rates that have risen and people out of work for an extended period, is to have 3 to 6 months of your essential expenses saved. So as you will recall earlier, I asked you to label each one of your expenses as whether it was essential or discretionary. So in an example of having $2,000 a month in essential expenses, we'd be really looking at creating a savings account or a money market or some type of liquid asset that would have $6,000 to $12,000 sitting there in the case of us losing our job for an extended period or some type of an emergency. And lastly, once we've been able to accomplish these things, we've been able to create our $1,000 of savings to battle any unexpected expenses. We've been able to pay down any high interest debt that we may be carrying. And we've been able to create a 3 to 6 month emergency fund. We'll really look at, can we invest our money now? Can we increase our retirement investments, maybe save for a new home or car, or potentially our child's college tuition? At this point, once we have all these other steps accomplished, we'll look at trying to invest or saving our money to things that we may need in the future. Now, we've covered a lot today on the basics of budgeting, and we'll be happy to help you. So if you have any questions around today's presentation or just in general, feel free to reach out to Rich Myers or myself at Retirement Plans Inc. I appreciate it and look forward to next month's installment of our financial wellness series through Straight Talk Tuesday. Have a great rest of your week.